Here, again, we want to make sure that you're not putting yourself or your company at risk. So we want to make sure that when you are taking on financing, whatever it is, that your interests are being protected. At the same time, you have to have this balance because the investors are putting in money, and so they want to make sure they have some protections for their investment as well. And then the third piece to think about is some of these types of financings are a lot quicker to get done. They're a lot more straightforward and simple. And as a result, you'll spend less time, less lawyer time, and it'll be a lot more cost efficient to do it. And we'll talk about the different times and the different reasons you might go into each of the different types of financings. So maybe we'll pause here really quickly and talk about why somebody might want to raise an equity round. You know what, I'm going to do this in reverse order. Let's talk about debt first, because that's a little bit easier. So let's talk about convertible notes and safes, Alison. A lot of times, you may think, oh, I want to go out and raise, a round, and I feel like my company's, valued at $25 million. You're talking to 50 different, firms, they're not biting, and you're running out of cash, and you sort of need that first infusion to really get to some of those early milestones. So talk a little bit about how a safe or convertible note might be attractive.
Yeah, so we see most early stage companies these days doing their first round of financing with a safe or convertible note. As Jeana mentioned, they are faster and simpler in terms of documentation. And so, as you heard the excellent founder panel talk about, they feel like they're constantly fundraising. And that is the truth and the life of many of our entrepreneur and startup clients. But safes and convertible notes simplify the process for a couple of reasons. The first is that you're not establishing the valuation today. You're punting that to a future date. When you do a price round, the notes will convert into that price round, typically at a discount, and the safes as well. And so that takes that huge question, as Jeana mentioned, kind of and says we can agree upon that later. Somebody else, the next big financer who comes in will set what that price round is. We don't have to have this conversation now. And I would say that takes, 50 to 75% of the battle and puts it aside to a future date. The other thing is there are very few levers that terms that you would insert into a convertible note or a safe. They're generally understood to be pretty formulaic, and if you stick to the forms that people are used to seeing, there are just a few terms that you can change to negotiate with investors. So you find yourself negotiating a lot fewer terms, and it's just faster, better, and easier. And why most people do this is because of those reasons. That you don't have to spend the time and the resources to do it, and you can punt on that valuation question, and nothing changes on your cap table. That's the interesting thing about this. Your board of directors generally stays the same, and your cap table is the same because these safes and then these notes just sit on the side, and they convert when you do a price round. And so you preserve your cap table as it is today. You know that these will convert at some point in the future, but it just simplifies the process by magnitudes.
Yeah, and sometimes these rounds can also be a little bit smaller. It can sometimes be hard to put together a larger round. And so, there's an understanding that if you do a seed round or a Series A round, there are certain market terms typically that you want to raise a certain amount. You'll have to take a certain dilution. And with notes and safes, they can be maybe you only need a couple $100,000, and it feels like a lot of overkill to go and do a full price round for just doing a smaller raise like that. I know that sounds like a lot of money right now, when you're first starting out to get a few $100,000, but you're not trying to raise millions of dollars initially sometimes.
Yeah, and maybe it's good for those who are less familiar with the terminology for us to state what really I see as being the difference between the safes and the notes. Jeana mentioned earlier, convertible notes are debt, safes are not. What that means is it means two things. Convertible notes come with an interest. They will accrue interest over time. So the longer that sits out there before it converts, the more equity that investor is going to get in the company and the more equity you're going to give away. So it's less company and founder friendly, more investor friendly because of that accruing interest feature. Safes, on the other hand, do not accrue interest, so the terms that they're negotiated at when they're signed are the terms that you know exactly how they're going to convert when you do an equity round. The other feature of a convertible note is because it is debt, in the event you liquidate the company, debt is always paid out first.
Yeah, and so there are some similarities also, and this is, I'd say, maybe a little bit the negative side of doing notes and safes. And those are, aside from the interest, which is, typically something 4, 6, 8%, it's not huge, but it does accrue. And that's that when the note converts or the safe converts, investors will oftentimes negotiate, they get a discount on that conversion. So they're not going to pay the same price as your seed investors. They're going to get a 10%, 20%, 30% discount. And that's negotiated. A lot of times I see it somewhere around 20% discount. And similar for safes. And then the second piece that you might see negotiated is what you'll hear called a valuation cap. And so you're thinking, well, I thought we were punting valuation down the road. Why is there this valuation cap? And the general idea is that even at the note stage, financing stage, there's a general sense of, hey, I think the company is worth about $10 million, for example, pre-money, and I don't necessarily want to price it, but in order for these investors to feel comfortable, entering into this financing, if it turns out that I don't do a financing that's at least $10 million, they're going to get the benefit of it as if it were a $10 million pre-money valuation. And it's usually, they get the better of the two. Not all notes necessarily have both features. Investors who are sophisticated will usually ask for both of them, but those are the two pieces to look out for.
Yeah, I agree. And so when you go out and you do one of these rounds, either a safe or a convertible note financing, you want to talk with your advisors, both legal and your strategic advisors, to see what their thoughts are to help you hone in on what you think the market will invest in your company at. Ideally, you want a safe without a cap and a lower discount. That's the most company and founder friendly. But to get a deal done and to get money in the door that will allow you to get to your next round, oftentimes companies will take that cap. And the idea is that early stage investors, they're not investing in debt in the company. They don't want to be debt holders. They want to be equity holders. And they want to get the benefit of taking the risk and putting the money in at this early stage.
Yeah, and usually these notes are expected to convert within a year. The maturity date is usually set about a year. And then after that, you're supposed to start making payments in cash on the notes. Having said that, usually these are friends and family, angel investors, very, entrepreneur friendly. They're not, in it to get the interest. And so a lot of times you can work with them. They know if financing is imminent, and they'll continue to put it off, or you can formally amend the notes to give you more time before repayments have to be done.
Yeah, I was going to say we always talk about safes and notes in the very early stage financing context, but the other place that we see them come up is between rounds, and there you'll often hear the term bridge financing, and that's when you've done your Series A. You want to gear up for a Series B, but you need a little more of capital infusion into the company to get to those milestones that is going to help you do your Series B valuation or your Series B raise at a higher valuation. So these tools can be used between rounds as well. Most frequently we see them as the first fundraising mechanism right out of the gate.
Yeah, that's a good point. I mean, I've done bridge notes between rounds that are like, $50 million bridge or $100 million. So they want to do like a $300 million raise, and so the existing investors are often the ones who will bridge while you're going out to look for a new lead investor.
Right.
Okay. So then going back to equity, so that kind of covers notes and safes. So
should we stop and see if we have questions about?
Yeah, we're not going to be back to those. We're going to go now to equity.
You can come back later with questions too, but anybody have any questions on that piece? All right.
Okay. So equity, we'll go through the different types of stock really quickly. Common stock, when we talked in our earlier session about founders, option holders, those are common stock. So that typically has very few rights, other than being able to, vote on general corporate matters, like a sale of the company. You generally don't get a return on your investment unless you sell the company and everyone just gets sort of the pro rata proceeds after preferences are paid out to the preferred, which we'll get into. And so really, it's really hard, as a founder, of course, it'd be great if you could sell common stock. In the hundreds of deals I've done, I think I've done 2 common stock financings, and everything else is preferred because the investors are paying the premiums. They want special rights that don't necessarily attach to common stock.
Yeah, I agree with that. And most companies are willing to give those special rights for that higher valuation, right? It's a trade-off that is negotiated, and that almost universally we see outside investors coming in and wanting preferred.
So then the question comes to what kind of preferred? And so you'll hear Series C, Series A. Those are usually the 2 options. When I first started practicing, everyone started with the Series A. Over time, that evolved into a Series C, which became pre-A. And the idea there was, people have continued to raise funds, and there are just certain market practices, right? If you know that you're going to be doing multiple rounds, you don't want to become like a Series Q preferred stock round. You want to sort of preserve your rounds for what makes sense. So there in people's minds, if you're a Series A company, there's certain expectations of where you are with your product, where you are in the maturity of your company. Same thing with B, C, D, and so C allows you to preserve a little bit of that time, and now is pretty much the norm. And we'll talk a little bit about the differences, but in general, preferred stock, there are going to be certain economic and governance rights that you have, and those are the 2 main things that people care about. A usually comes with all the bells and whistles that we'll go through, and the C usually is kind of a light version. You punt on a lot of things, because as an early stage company, you're not thinking about your IPO too much, so you might push some of that off. Usually the protections tend to be a little bit more limited. Again, there are so many market practices in these areas, and so we'll kind of go through that. And the type of investors that you get at the C versus A level may be different too. We still start seeing some institutional investors, but they may be really focused more on early stage. It might be some angels as well, and so the diligence and the level of scrutiny might be a little bit lighter than an A.
Yeah, and we note here that price rounds typically tend to be a lot more expensive than those convertible notes or safes, and I think a lot of those reasons are what Jeana talked about. But the documents for our preferred stock financing are 4 to 5 documents, each 20 pages. They're pretty dense. Those of us that do this day in and day out are very familiar with them, and you want to get somebody who, when you do a price round, you want to get somebody who is very familiar with them, because you want things to be pretty streamlined, because it is dense reading, and you want to make sure your documents all work together. The other reason that it becomes expensive really is that diligence. You'll be asked to make certain recs and warranties about the company, talking about its operating history, any litigation claims, employee status, financial statements, all sorts of things. You'll make these representations and warranties. Whereas in the safe and the convertible note rounds, the reps and warranties you're asked to make are a lot smaller. They're a lot skinnier, so a lot less time goes into doing that.
Okay, so I think we talked about the spend as well, typically later. Okay, so then moving forward, we'll get to the actual term sheet. And here, we'll outline all the different parts of the term sheet, but pause on the ones where, again, most of the negotiation happens, and most of the things you should be aware about. Something that you might hear early on is, Alison referred to the sort of 4 to 5 documents that are going to be produced. So this term sheet will, be negotiated early on. Once you come to agreement on this, then that'll get translated into, hundreds of pages of documents. And there's a set of forms called the NVCA forms, the National Venture Capital Association. And there's really been a lot of mainstream kind of thinking that has formed. There are obviously points that are negotiated, but for the most part, there are so many financings that have been done by venture capital firms, law firms, companies, that really, when you come down to it, there's really only a handful of terms that actually get negotiated, even though you'll have hundreds and hundreds of pages. So you hear that term, that's what it's referring to. So we talked a little bit about preferred and common stock, so we'll pass on this one. And then we'll get to what we were talking about earlier. So really there's two sets of rights that are being negotiated. They're the economic rights and the governance rights. And the economic rights are basically what's going to be the return on investment. You know, someone said earlier, you know, investing isn't philanthropy. They want to make money, and a lot of times they want to do better than just putting their money in. So, you know, these protections go to making sure that they get some return on their investment. And we'll go into detail in each of these, and so sort of a quick highlight here. And then, do you want to just cover governance really quickly?
Yeah, governance is the non-economic terms. This is who sits on your board, how your stock vests as founders over that time period that we touched on earlier, what kind of voting rights, you'll hear that referred to as protective provisions. So whose approval do you need to get to do certain actions? Really important pieces to both be aware of at time of negotiation and as you go forward as a company. And then liquidity constraints. These are things that prevent you from being able to sell your personal stock to another investor without first offering it to the company and to other major investors. Other investors, co-sell means, and tag along means other investors selling alongside you. So if somebody comes up to you and says, I'd like to buy your stock for $10 million, you can't just sell it to them. If you have these rights in place, there's a whole process and procedure you have to go through. And a drag along means it's a mechanism used to drag shareholders along in voting. So if a certain number of board members and shareholders approve a deal, you don't get a say in it. You have already pre-agreed and basically provided a proxy or a vote to approve that deal. So these are really important things to be aware of. I think there's always a lot of focus on the economic terms because everybody wants valuation is what most founders use to judge how well they're doing as a company, what term sheets initially look most attractive. But these governance things can be really, really important. To the founders panel, again, to talk about their board of directors and who sits on that and the value that they bring, I cannot express that enough.
Yeah, and the reason that the founder restrictions are in this governance section is something that was referred to in an earlier panel. You know, early on, investors are really looking at the team. They really want to make sure that the team they're investing in is going to stay in place. You're not going to turn around the next day and sell off, your ownership, and then suddenly it's a whole new team they've invested in. So they care a lot about making sure that the team they're investing in has skin in the game and is, going to talk about earlier. You can put no vesting on your shares initially, but they're going to probably want you to stick around for a few years. And they might say you need to change that and now add vesting, so you stick around for a few more years. And if you want to sell your shares, you need to quit with us first. If it's building creating a trust for tax reasons for your kids, that's fine. But if you're going to go sell it to a competitor, or something like that, then no, thank you. So, all right. And then this one we'll just touch on briefly, just so you know. These are other terms that typically early on you're not going to negotiate too much. But registration rights are when your company is listed publicly, how you're able to participate in selling your shares in the open market and what rights you have there. Information rights are financial statements, cap table, budget, opportunity to see that information, have access to that information. We touched on board observer earlier. Again, you don't want to give away too many board seats, too many voices, too many decision makers in the room. Initially, you'll just want to keep that a small group of people, but some investors might want that information by being able to attend the meetings. Exclusivity is once you sign the term sheet, that means you are only going to negotiate with that investor for the next usually 30 days to work on the 100-page document, so that all the work they're putting in, you don't just take that turnaround, give it to someone else, and then pull the carpet from under them. Expenses. This is something that I know founders don't love. The expectation is that you will have to pay for the lawyers for the investors, and you'll cap that. You negotiate what that amount is, and for a seed round, Alison, I don't know what you're seeing these days, kind of anywhere from 10 to 20 maybe $1,000. Yep. And for A, what are you seeing?
I'm seeing it depends. If it's an insider round, they've already been involved in the company and know a lot about the company, or if they're a new investor coming in. But I'm seeing anywhere from like 35 to 75 for an A round. And so, yeah, it is something to be aware of.
Yeah, and then confidentiality is, obviously making sure that both sides keep the terms confidential. This one, it's a lot of information here. We'll kind of go through what these mean. This table is going to be helpful for you to have as a resource, and this, again, you'll get these materials, but this is super helpful as you think about, which side, company versus investor side, these things land on. And Alison and I will hit on what the norm is, where you have a little bit of leverage and where, you should just sort of accept that this is what the market terms are.
And I would say, back on. I would say, even if you are not on the precipice of going out and doing a price round, or you think you're far from this, I would familiarize myself with these terms from day one, because it makes you look knowledgeable in the space. It makes you prepared to have unexpected conversations that people may come to you and say, what are you're raising money, what valuation, what liquidation preference. It allows you to speak like an entrepreneur who is seeking venture funding. And that gives you credibility. So I would familiarize myself with these terms from the get-go and ask questions of legal counsel. As soon as you get those term sheets coming in the door, or you're thinking about going out and soliciting them, no question is a dumb question. Make sure you understand every piece of the term sheet. Yes?
So negotiation of this term sheet is done through the legal representation, through attorney, or could be done through founders and VC?
Yeah, great question. So the question was, is the negotiation of the term sheet done through attorneys or the founders and the VCs? The answer is it depends. Sometimes sometimes our investor clients will just hand us a signed term sheet and say, we signed this term sheet, can you please draft the documents? Our company counsel clients, when we are counsel to the companies, we're often very involved in consulting on the terms and the term sheets and going back and forth. Whether we are the carrier of the document itself back to the other side and the deliverer of the messaging of, hey, we're willing to accept a lower valuation, but we're not giving you a board seat, or whatever it is, often just depends on the dynamics of the transaction. And I think that companies who have executives that can speak to the terms do very well, because they can have knowledgeable conversations with investors, and kind of, it's almost a heart-to-heart, right? This is what really matters to me. And you keep the lawyers on the sideline, consult with them, prepare yourself to have those conversations. So don't not use lawyers, but if you can educate yourself in a way that you are capable of conveying what matters to you at the investor to company level, I think you make a lot more progress, or have the ability to make a lot more progress than just going through lawyers. Because sometimes people have the take of, this is just lawyering, right? They're just over lawyering. That's not, the company doesn't really care about this, even if the company really does care about this. So that's another reason to really get knowledgeable on these terms.
Yeah, and I sometimes will have founders, because I understand that you don't want to spend a ton of money just early on when you don't even have a signed deal, but I'll sometimes get a request just to say, hey, can you do a sanity check? Does this look right? Because your investor, if you're dealing especially with an institutional investor, they've done thousands of deals and you've done 0 deals. And everything sounds friendly, but they may assume you understand what this means because they say the term and you're like nodding, okay. And I've had multiple conversations after the fact, like, do you realize what you gave away when you said yes to this? And they weren't. I don't think the investor was being, trying to be sinister or tricky. They just assumed that you understood it when you said yes. And so that's fine to accept it as long as you understand the question.
And going back to what you were commenting on, Alison, how common or uncommon is it? Like, say for instance, you're working on a Series A, and you're working with a group of investors. There's a syndicate of investors. I mean, when you're working on a deal like that, are you trying to keep terms uniform amongst all investors?
Yes. Yes.
Or somebody will come, hey, I want this. I want it structured this way. Or Is it common
Yeah,
to keep it uniform amongst this
You
syndicate
really
of
want to
investors?
try to. It
Okay.
becomes very tricky, especially in those early stages where, you have 4, 5, 6, 7, 8 people
Yeah.
that you're dealing with. The advice that we give is find your anchor investor. Figure out who matters to you most. It's usually the biggest check writer, but it can be one of those more strategic investors who's gonna prop up the company. Find who matters to you most, negotiate the terms with them, and then tell everybody else, these are the terms.
Okay, they'll follow the lead.
Because they'll follow
Okay.
the lead.
Okay.
And if they don't, it's probably not worth your time, effort, money, and energy to deal with somebody who doesn't fall in line. You will have some investors that have specific criteria. We require this specific term or this side letter or these financial statements to be delivered to us. And you can deal with those separate specific asks, but these main terms, as much as possible, you want to let that lead investor lead the way and expect and hope and convey to everybody else that we expect them to kind of follow suit.
And if there's too much deviation on some of these, like liquidation preference, you're selling a different series. Like you can't sell, one kind of liquidation preference to one Series A investor and then a different one. That becomes your Series A1 or something like that. So it gets complicated. Another question up here? Yeah.
That's a great question, and it's a reality we see all the time. And coaching and counseling people through that's a really important thing. Because if you go out there trying to make everybody happy and meet everybody's terms, you have created a beast.
Yeah.
Hey, Jeana, could you comment a little bit on what's the market right now for liquidation preferences?
Yeah, let's go through this really quickly. So liquidation preference is basically when you sell the company or you have to wind it down, what gets paid to the investors and in what order, what priority. And so what's been market for years has been 1x, so just, the original investment they put in. And then afterwards, actually the greater of that, or if you have a high enough, purchase price from a sale of the company, what they would get if they converted to common stock and everyone just participated pro rata. So that's the norm. During more challenging economic times, you might see that multiple go up to 1.25, 1.5, 2, 2.5. I haven't seen that happen yet, even though we're starting to see a little bit of volatility. People aren't touching that. The other piece that we'll get into is what's called a participating preferred, and that is the second piece that is pretty punitive to common stock. And so what that means is if you're the preferred stock, you can get the better of your original investment or what all the common stock will share. But if you're participating, that means I get my 1x plus I'm going to share pro rata with everyone else, so I'm always going to come out ahead. And we also haven't been seeing participating preferred come back into negotiations, but those are the two things that you might start to see if we get into more turbulent financing waters.
And then, so these are common terms, but lately I've been seeing more on mission alignment with the fund terms, things like criteria around D&I, composition of executives, or open source data use, and things like that. Can you comment on some of the more extraneous ones? Or
Yeah, I'm happy to comment on that. I think with the evolution of the kind of ESG, environmental, social governance factors, and focus on company culture and initiatives, we are seeing those terms come into term sheets. I think that it helps, number one, ensure that there's kind of strategic cultural alignment. So I welcome the asks. The other thing is a lot of funds go out. So the funds, whether it's private equity, venture capital funds, they go out and they have to do their own fundraising. And so they go out and talk to limited partners and have to sell them on why should you invest in our fund and trust us with your money to go invest in companies. And so a lot of this is dictated by their own funds, where they say, in their fund documents, they'll say, we're going to invest in at least X percent, 25%, 50% women and minority-owned companies. We are focused on climate change or whatever it is. And so some of that is dictated by their fund structure itself. So yeah, I would say in the past 2 to 3 years, I've been seeing more of that come up for sure.
And I can see, I don't know, I'd be interested in your experience, Alison. some companies from the very beginning, the entrepreneurs are very focused on these missions and values, and so I would say that when the investors are asking for it, it tends to come in a little bit later stages. I think the earlier stages, your angels, you don't see it as often. So that's kind of where I start seeing it come up more frequently.
Yeah, that's right. And there's a whole other entity status that we didn't cover earlier, B Corps and B certifications. If any of you are interested in that, I'm happy to cover those details separately with you.
And then, so we just want to make sure that we hit on a few more of these points here. Dividends is one of those that it's in every strict incorporation, but you should have it so that it's phrased that, it's only paid if and when the board declares it. And I'd say that in 98% of my deals, boards never declare dividends because you don't have excess cash to distribute. And investors typically, if you do have more cash, want you to reinvest it in the business. I do see private equity firms be a little more aggressive on this, where they will want some sort of return. Cumulative dividends, if you have an LLC, you'll sometimes see this as well come up more often. But for the most part, it should be sort of a non-cumulative, only when declared by the board, and sort of move on.
And for those that the term dividend is a new term to you, what that basically means is a payment of a percentage of their original investment when it's declared by the board. So sometimes you'll see stock have 8% mandatory dividend attached to it. What that means is that investor would get 8% of their original investment back on an annual basis. So it's very aggressive, and like Jeana said, most companies who are in growth stage don't want to see cash leaking out of the company because they need to put that cash to work to grow the company, which is why most VC-backed companies don't have dividends.
And then anti-dilution is price protection. So when an investor puts in, pays $1 per share for the Series C, they don't want the company to turn around and sell it for 50 cents to the next investor. And so if you, are going to sell it for a lesser price, like you have a down round, then there's certain protections. And so what happens is when your preferred stock converts to common stock, you'll get to convert at a greater than 1-to-1 ratio. So you'll eventually get more common stock. And why that's important is, one, if you decide to go public, at a point where you're going to convert your preferred stock to common stock, you'll get more shares, one, so it has economic benefit. But two, generally when you're voting on anything, you're voting on an as converted basis. So you'll have more votes when you convert into common stock than you do preferred. And here the practice has been for years this weighted average. And so it's not that you get, if you're a Series A investor, 50-cent share, and you're a Series C investor for $1. A full ratchet would be, okay, we're going to just change it so that, we adjust your conversion price to $1, 50 cents also. So that's full ratchet, where you get the full benefit of whatever the later investor gets, and that's very aggressive investor term that we, again, haven't been seeing come back. The weighted average is a very complicated calculation, but basically it's, taking your fully diluted shares, and it's just a small sort of adjustment so that, typically it's, a very small percentage additional shares of common that you would receive.
Yeah, and it's all mathematical and formulaic. I think the important thing just to know is if you do a down round, understand how it's going to impact your cap table and how it's going to impact prior rounds, because I think a lot of us think you do your Series C, you do your Series A, and that's it. That's the stock that they own. They're set in stone, but this mechanism has a way to change that. So if you're going to do a down round, which is a financing at a lower valuation than your prior round, make sure you understand how it impacts the cap table throughout, including your prior rounds.
So there you'll want broad-based weighted average. Redemption right is basically the right for an investor after a certain number of years, if the company doesn't have a liquidity event, you don't sell the company, you're not public, that they can put the shares to you so they can force you to repurchase the shares from them. And that's, again, a very aggressive investor right that, we see in, I don't know, maybe like 20% of deals, something like that. I don't know what the latest is. So it's in some deals, but I'd say in the vast majority of deals it isn't. That's another one that we can see creeping back. Usually the time frame tends to be 4, 5, 6 years out. Obviously, we don't want to be in a position where you have this hanging over you, and so each time you do new financing, usually gets pushed out again another 4 or 5 years. This can start to become a problem if you start taking on venture debt, because if somebody has a right to get a repurchase, shares before that term loan is due or things like that, it can complicate matters. So I would resist giving redemption if possible. Any other words on that?
Yeah, I think that's right. The other thing, it can destroy that special treatment that I talked about earlier, the qualified small business stock. If a company redeems a certain amount of shares, it can ruin everybody's tax treatment. So you gotta be really careful about it and try to avoid it. I guess one more thing, it can be a tool that can be helpful too. If you have an investor that you're not sure about, or you're kind of taking a risk on and you want the ability to buy them out, a redemption at the option of the company can be a tool to do that. So it's not always terrible, but make sure you understand it because it has big economic impact.
Yeah, and if you do go down this route, there are a lot of different flavors. Like one of them is what Alison mentioned, is at the company's option. Usually the investors will force it, to be at the investor's option. Sometimes it's all or nothing. Sometimes it's, at the price that you originally paid or the fair market value, the greater of. So these things can get really hairy, and there are a lot of different alternatives that, again, you should speak to your advisor because there's not really one size fits all. Veto rights are what we talked about earlier in terms of there's a lot of areas that your stockholders, your preferred holders are going to want to be able to vote on. So once they invest, they don't want you to go and sell the company immediately at a price that they're not happy with. They may not want you to increase the size of the board, suddenly add 5 more common directors so that they're, they never have a say. So there are a set of negotiated rights that are conditions for them putting in their investment.
And I'd say if you close around and you have certain voting protections, make yourself a little chart or have your attorneys do it. So you can always keep in mind, am I doing something at the company that requires somebody else's consent? Because people trip over these and don't even realize it. They grant a security interest or they increase option pool without getting the consent of the preferred holders. They do these kind of things. So keep them in mind, keep them top of mind. Don't just tuck all your legal documents away after you close around and be happy that you're done with it. Because there are ongoing things that you've got to comply with.
And then right of first refusal, we touched on this earlier. So this is typically investors saying, okay, co-founders and other maybe key executives, we're investing in you, and so you can't just go freely sell your shares to anyone. So what happens is you have to first offer to the company to buy back. A lot of times the company doesn't really have a ton of cash sitting around, so they may not buy it back. So then the large investors will have a chance to buy your shares. And then there's kind of a third sort of step, which is this co-sale, which the investors may say, you got a great third-party offer to buy your shares for $10 a share. That's a little rich for us, but we want to participate. We actually want to sell our shares, so we get to sell a portion of our shares for $10, and you can't sell as many as you want. So as a founder, you're like, well, that seems really unfair. You could find a great third-party buyer, you've done all the legwork, and then they get to swoop in and basically take the benefit of, the work that you've done. But these are, again, part of the conditions that investors will put in. Do you want to, and then I think you touched on drag along already. We talked about information and board membership.
Yep.
So this is a super important chart. I know we went through that quickly, but this is probably the most important chart to really understand in our presentation. So I think we went through, and you'll get these slides, and so there's just a little more information about each of these that we've discussed. I guess on conversion, you want to just touch on the mandatory conversion for a minute?
Yeah, so conversion is the process where you've got preferred stock and it converts to common stock. Typically it's done in one of two scenarios. One is in the sale of a company where the preferred holder will figure out, do I get more money paid to me as a preferred holder with my liquidation preference, or do I get more money paid to me as a common holder? What you want as a company, in that context, you want all your preferred to convert to common because that means you're all getting a really big payday. So that's best case scenario. The other case that it oftentimes converts is in an IPO. And so you want to be careful that you negotiate those terms of when it will convert to common stock automatically upon what we call a qualified IPO, which is an IPO of a certain size that raises a certain level of money for the company. And so if you don't have provisions that you meet to force that automatic conversion, then they have to consent to it. So then you've got a situation where you've got potential investors who could block an IPO. So you want to make sure you're careful. Not every company IPOs. Most companies do not IPO, but you want to think about it as you go through. Direct listings and SPACs have become kind of the new up-and-coming terms. SPACs were really hot about 2 years ago. I don't see many of those these.
Yeah, there's a lot of fallout. The SEC has really been scrutinizing them. There's a lot more potential litigation, disclosure. I've had a few de-SPACs fall apart in the last 6 months. So they've a lot of them have either decided not to go out or,
So we could do a whole separate session on that.
Okay, we talked about anti-dilution. Yes, question.
What are you guys seeing about vesting of founderships?
Yeah, I think we covered it a little bit earlier, and
What's the market these days?
I think it depends who you ask. I still think it's 4-year vesting with a 1-year cliff, and then monthly over the next 3 years. I do see more companies who are asking for refresh grants, doing more milestone vesting, and some companies reserving change of control vesting for those like reach shares that would be only vest on that on an exit. Do you have different data points or?
Yeah, that's pretty consistent with what I'm seeing too. Any other questions? We have like a few more minutes. I mean, we have this slide on board composition. We can end it there. So, we've had a lot of discussion about board. Obviously, who you choose as your investors is really important. And then you'll really hear from them directly when they're serving on your board. You don't want too large a board early on. Typically, when you're first starting out, maybe you and a co-founder, maybe 2 of you or 1, because having an even number of boards sometimes is a little challenging if you're deadlocked. And then maybe you'll want an independent just to have someone with some industry experience. Once you start taking on investors, oftentimes they want a board seat, and so it becomes this like, well, if you already have, if you only have 1, then you add 2. Again, you try to get these odd numbers, but usually you can work through those issues. I think the key thing is to try to keep it to a balance. Sometimes you start losing control of the board at your Series A round. With my clients, I try to push that out to like the Series B so that you still have 2 common directors, maybe 1 investor, and you leave it at that. Sometimes once you get to your Series B, you might ask your Series C investor to roll off so you can get that seat up to the B. So there are kind of norms that you can do with this, but it's super important to have a board that you feel comfortable with and are aligned, but can also bring value.
Yeah, I was going to clarify a statement that I made in our last presentation about making sure that you have strategic alignment with the board members. That doesn't mean you should surround yourself with yes men, because nothing good comes of that if people aren't willing to tell you when they see problems and help advise you and get you through that. So you want to, strategic alignment generally and what you see as the company's long-term future and strategy. I think having alignment on those things is good. Having the board members that can bring that value, can bring contacts to help you raise your next round of financing, who fill the gaps, the skills gaps that you might have as a young company. And board members, you also need to think about how much do you want them in your hair. Do you want somebody who wants a weekly call and an update and lots of information and have that sounding board? Or do you want a far more passive board member who attends your quarterly board meetings and asks 1 or 2 questions? There's all different types of board members out there, and just it's good to do your own diligence and understanding who they are. And when you bring on a VC, sometimes the VC that you negotiated the deal with doesn't end up being your board member. They put one of their partners in on the board. And so having an understanding of who they intend to insert, because they'll get a right to designate that board member, which means they get to choose it and you don't really get a say. So having a conversation at the term sheet, like who will be the board member, is a good conversation to have.
Yeah, and I often see that as you start to mature, the things that the board wants to see in your board meeting, like our clients will spend like the week leading up to basically preparing the board deck with all the information, all the metrics that they want to see, and so that becomes another part of your job as CEO, founder, that maybe you weren't anticipating when you first started. Yes.
One of the things that we see is that some really early stage, especially in the university, they make their family members their board members to start, or their father-in-law, or somebody like that. You can talk about the problems that creates.
Great question. So question for everybody, make sure you could hear is, sometimes early stage companies invite family members to be board members. What are the maybe positives or drawbacks from that? I don't know that there's a lot of positives to come from that, unless you have extremely well-connected, smart, valuable, kind family members who can contribute. If your father-in-law is the CEO of a large technology company that sold last year, yeah, maybe bring one as your board member, right? That looks great on a slide deck. Apart from that, doing business with family, whether it is taking money or inviting to a board, is territory that we see rife with conflict. If somebody is not really going to bring value to your board, there's no point in giving them a board seat. And so I would really discourage you from that. Your board should ask the hard questions of you. They should help you and guide you and provide strategic advice from what they see in their other companies that they have invested in or sit on a board with. And a family member is meant to support you and give you a hug and hold your hand. But I really would advise against having family members as board members, except in those rare outside cases.
Yeah, and we don't want to go into the next session, so we'll wrap up here. Something that we didn't talk about that we're happy to talk about sort of afterwards too, is a lot of times I get questions from founders early stage who might say, talk to me about super voting rights or super board, votes so that I can maintain control, even if I add in additional investors or add in additional board members. Certainly it can be structured that way early on. It might scare off some investors depending on how those terms look. Kind of depends on how much leverage you have as an entrepreneur, but those are things that sometimes will also come up.
Yeah, my parting advice on the term sheets as you're negotiating them is to understand that they have, the term sheets and the documents themselves have a very well-versed structure. If you try to get really fancy and unique and ask for weird things, you'll turn off investors and you'll lose a deal. So talk to your counsel, your advisors about what really matters to you. Come up with a term sheet that you're reasonably confident with, and sign on the right parties that you feel are going to be the right partners for your business.
Thanks.
Thanks, guys.